Good afternoon, ladies and gentlemen, and welcome to the MIGO Opportunities Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Will Hampsey-Cook from Frostrow Capital. Good afternoon, sir.
Good afternoon, and thank you everyone for joining the MIGO Opportunities Update webinar at what is a particularly interesting time for the strategy. You might have read recently that the board have appointed AVI to become the company's investment manager, and they are expected to commence in Q4 of this year. Up until that point, Premier Miton remained the investment manager, and Nick remains at Premier Miton to manage the portfolio. Nick, of course, resigned from Premier Miton, and his affairs after he leaves are a matter for him. But it's pleasing that AVI have hired Charlotte Cuthbertson, former co-portfolio manager, to manage MIGO when it moves over in Q4. AVI has also informed the board that it expects to be able to announce a further senior level appointment with relevant experience to work alongside Charlotte in the coming months. Now, onto the exciting stuff. As a reminder, MIGO is a deep value special situation vehicle seeking to exploit mispricing opportunities in the closed-end fund world, buying discounted investment trusts where, importantly, there is a catalyst for that discount to narrow. And to provide some context, what you can see on screen is a long-term average discount chart for the investment trust sector dating back to 1990. And what's striking is that outside of the global financial crisis, we are touching record levels. Why is this important? Well, historically, MIGO has generated its best returns when the average underlying discounts on portfolio holdings are at their widest. The reason being, if you identify an out-of-favor asset class in an open-ended structure and sentiment changes, your return is capped at the NAV return. However, if you identify the same out-of-favor asset class held within a closed-end structure and trading at a discount, you have the potential for the powerful combination of a rising NAV and that narrowing discount. And Nick has an illustrative chart later on to put some numbers to this. But outside of the theoretical, you only have to look back at MIGO's performance history to prove this is the case. 2016 saw discounts widen due to the Brexit referendum, and the following year, MIGO generated share price returns of 32%. Again, in 2020, when discounts widened due to the COVID pandemic, the following year saw MIGO return 25%. And in 2008, when discounts became extreme, MIGO generated 45% the following year. Now, we often educate shareholders that an investment in MIGO can be periods of watching paint dry intertwined with explosive runs, the likes of which I just mentioned. And given discounts are so extreme at the moment, it's likely that the seeds for that next explosive run are in the current portfolio. So with that, I will hand over to Nick.
Thanks, Will. This update might be a little bit ad hoc, might be short and sweet, but we thought it would be handy to have one, given there's so much going on in the trust world and the perfect storm that the trust world has faced. Looking at that graph, you can see on the screen that probably understates the extremity of the discounts in the pool that MIGO is actually fishing in. And as I said, we've seen rapidly widening discounts. The trust itself has probably dodged quite a few bullets. It wasn't in the over-owned alternatives, and it had a large position in cash during that period. But Will's point is well made. Just looking at the perfect storm, which led to the dam bursting towards the end of June, there's 5 factors that I think were going on simultaneously that caused it. I mean, one was rising interest rate expectations, which is particularly important for the alternatives, the renewables, the song rights, the shipping funds, etc., because they were created as solutions to deposit rates being virtually zero. And of course, we've seen, if you can buy a short-dated gilt with a yield of 5.4%, why would you own an infrastructure fund, say, yielding 6%? Maybe that yield has to be a little bit higher. and obviously with the associated fall in the share price as the discounts widened sharply. That was the main thing that was going on in recent weeks. But there were other things, such as we were getting anecdotal reports from a number of brokers that some US investors were shorting the FTSE 250 as a negative play on the UK, but using the pure form of the 250 rather than the ex-investment trusts. And just to put that in context, out of that 250, 30 are investment trusts. So on a look-through basis, what was happening was that, you know, the likes of Vietnam Opportunities was being shorted as a way of putting a negative bet on the UK. So clearly that caused problems for the very larger trusts. The middle-sized trusts continue to, or have started to suffer because of the ongoing consolidation of the wealth managers into the big chains, you know, not least the merger between Investec and Rathbones. That's tending to affect trusts between maybe 500 million and a billion, which have always been large enough. But in the new world, they probably aren't large enough to be included on the buy lists of the wealth managers. And just, we're not there yet, but, you know, Investec and Rathbones getting together brings £100 billion pot. And if you see standardization of portfolios, maybe one day you need to allocate 1% to move the needle in a portfolio. That's £1 billion ticket, and I think, you know, it would be a struggle to buy £1 billion worth of Scottish mortgage, let alone any smaller trusts. So I think we're beginning to see widening discounts in the middle-sized trusts, and that is the area where some of the widest discounts are. We've got the ongoing problem of the OCF methodology, or the calculations to, you know, the recent rules, which means that if you own an investment trust, if in your own financial product, you have to declare the costs on that investment trust in addition to the cost of your own vehicle. And those, you know, that would have been set up as or drafted, you know, with long only equity funds in mind. But of course, once you start looking at a private equity fund or a shipping fund or a song rights fund, you end up with, or second-hand life policy in our case, you end up with some very strange results, which makes some trusts, you know, uninvestable for that type of investor. So we have structural selling. And also on a recent trip to the Northwest, you know, because investment trusts have struggled because, you know, the discounts have widened, so they've been underperforming their own portfolios. You know, they're coming under selling pressure from some advisors, because, you know, what we found was that no advisors are getting anywhere close to their benchmarks, because basically all the gains are in 6 or 7 you know, tech stocks in the States. You know, the FTSE 493 is actually down year to date, whereas the you know, the other 7, including the S&P 500, generate the whole gain. So unless you're chasing AI, you're going to appear to be underperforming significantly. And I think that some advisors are feeling under pressure, and investment trusts are an obvious target because they act as a drag on client portfolios. So yeah, you've got those 5 things all happening at once, leading to a dramatic widening of discounts. And we'll touch on a slide later on, but the average discount in the larger trusts owned in MIGO has touched 31%, which is something that we haven't seen. So how are we sort of reacting to this? Well, an obvious area is there's an opportunity for arbitrage in some of these alternatives where there's no demand for the actual product, there's no demand for the structure, because, you know, a lot of these issues are quite large, and you know, they're physically too large for the investment trust market making mechanism to cope with. So they've drifted off to very, very wide discounts. But actually, there are a number of situations where the assets that trust actually owns is very much in demand. So there's an arbitrage there between what's going on in the trust itself and what's actually going on in the portfolio. And one that we bought is a Keeler European, and basically, if you look at new production, new solar plants, new wind farms, you know, which are being put in place, the valuations there, or the cost, are around twice as much as just buying a Keeler at a big discount. You know, literally, you're buying a package of solar plants and wind farms. You were buying these in at literally less than half what it cost you to build new ones, and that can't be right. So unless the real world starts to value those assets properly, somebody will come along and buy it. Certainly, out on the road, we're hearing. You know, a lot of people call it the death knell for investment trusts. I mean, I've heard this many times over the years, and we're down to our last 182 billion. But the trust world, if you look back in recent years, has been very good at evolving, and there is the law of natural selection, and a lot of trusts, will merge, will disappear, will take a different form or structure. But I mean, every week we're probably seeing 2 or 3 more trusts get involved in transactions. So just looking down some recent examples, you've got Industrials REIT, Civitas, Aberdeen Japan, Columbia Threadneedle Property, Henderson Diversified Income, Shires, and the investment company, just to name a few. But a lot of capacity. If there isn't an audience, the sector is quite good at invoking natural selection. There's plenty of self-help, things that can be done. There is oversupply situation. We had a massive new issue boom in 2020 and 2021. So we do have oversupply in some areas, and therefore there will need to be buybacks. And you saw the announcement from Pantheon a few days ago that they're aggressively buying back, which will bring about some clearing in the market. Mergers, we've seen Aberdeen Japan getting together with an activist Japanese fund, Nippon Active Value, as a good example, and also new audiences. The self-directed investor is still very keen on investment trusts, and increasingly so. And also, the reaction of a lot of these mergers in the wealth management world is that a number of experienced teams are setting out on their own. And our trip around the Northwest, I mean, of 7 advisors, 7 shareholders who went to visit, 6 were now Raymond James offices. So very much, you're going to continue to see the growth of these smaller wealth management businesses running maybe 100, 200, 300 million, who are, very, very keen still on trust. So it's important for the sector to play to these new audiences. Just flicking on the screen. The other point is that there's a lot of the slide you got on the screen is one. It shows the diversification you get within MIGO, because all these asset classes have either been recently owned in MIGO or currently owned in MIGO. But you can see that most of these, for example, second-hand life policies or ground rents or mixed life industrial estates, would be impossible to have as an open-ended fund. So increasingly, the investment trust sector will be home for these sorts of mandates. And you can't operate these as open-ended. So there is very much the role. Looking at what we've been doing in the portfolio. Now, with all the chaos a couple of weeks ago, and there were 3 new trusts that were bought in, and I'm continuing to buy. So I can't name them, but just to give you an idea of the chaos and that we're seeing in some corners of the sector, the 3 new ones came in at a 41 discount, a 36 discount, and a 61 discount. And in the 61 discount, I suspect the NAV is going up, not down. We did buy a couple of more conventional trusts. We have bought into the activism in Japan, but also something quite mainstream for us, JP Morgan India. Now, there's been a change of management there. The new team seem to be, more adept at using the investment trust structure. But you have these windows where if the trust underperforms for a period of time, they have to hand back 25% at around NAV, and the new team have come in towards the end of a window, so they'll need to perform absolutely fantastically well to avoid handing back 25% in a year or so's time. But there have been plenty of opportunities to be able to buy this trust on a 20% discount in recent weeks. So the true discount you're buying into is much wider. Just a word on activism in Japan. I mean, sometimes experience is a hindrance, and I've been around for many decades, and every few years people tell us that it's different this time in Japan, and it never has been. And therefore, having ignored these trusts, or did initially ignore these trusts. But I think that might be wrong, and I think maybe this time it really is different, particularly in domestic Japan, and there's a lot of value to be released, and maybe the attitudes have changed. I mean, half the stocks trading in Japan are below book. There are 700 that are below half of book. Bear in mind that typically on these balance sheets they're 40% cash. We've got new Tokyo Stock Exchange rules that mean you have to explain why or what your plans are if you trade below book. And naming and shaming does work in Japan. A pragmatic approach will be listened to now, where it would have been just rejected even 2 or 3 years ago, and that's because there's the new generation aren't quite so keen on maybe operating as a metal basher in Kyoto rather than working as a corporate financier in Tokyo. So we've seen a doubling of the number of bids, with buybacks are sitting at record levels. So we're definitely buying into the change. And it's an important point here that actually the two trusts that we own trade on very narrow discounts, but the extreme discounts are actually in the underlying portfolio rather than in the trusts themselves. We could perhaps in the question and answer session talk about some of the winners and losers, but the three big winners over the period, and to give you an idea of the diversity in the things that we invest in, were Georgia Capital, Amido A4 Plus, and Industrials REIT, which was one that got taken over, which was was bought out by Blackstone. The team there, really couldn't see the point of trading, as an investment trust on a 36 discount, and could develop their business better within Blackstone. Blackstone took them out on a 3% premium, and I think we'll see more of that sort of thing, where the two ends of the spectrum will be particularly vulnerable, or areas where we see corporate activity. So the really good quality teams that can do something different with their life, and there'll be a lot of demand for them, and the poor quality where it's just really a case of hoisting the white flag after yet another disappointment. And again, the three of the weakest: Phoenix Free Deutschland, Baker Steel, and Geiger Counter. With Geiger Counter, was a bit of a strange one, really, because the uranium price over the period has been quite strong. But I think it's just got swallowed up in the complete lack of interest in the development of mines. Looking at the outlook, and I said this would be short and sweet. There's the top 12. This slide has been in the pack for a few years, but I mean, typically it used to be 15 to 20%. It's always going to be on a wide discount, because we're sort of value investors. We're looking for overlooked and unloved situations where there is a catalyst for change. So it's always going to be trading on a much wider discount than the average. But really, we've gone on through 25, and then we've gone through 30. Without even pausing for breath. And these sorts of, the point that Will was making, was the returns came after a period where discounts went out to 20 and 25%. I mean, this is probably the most extreme that I've seen within the portfolio. And MIGO's been around for nearly 20 years. And just a reminder, there's a slide that tells you why it's so important, if what's likely to happen if you do manage to buy in at a very wide discount. And this goes back a few years, and it's modelled on an eco fund that we bought, which had been poorly run. It had drifted out to a 30-odd discount. Infrastructure was definitely not flavour of the month for the period. But the important point here is the dark blue line and the light blue line. It's the same underlying portfolio. In NAV terms, if you'd spotted infrastructure as an out of favour sector that's going to come back into favour, you'd have made 40-odd%, which is very nice. But if you bought a bombed out investment trust trading in the sort of low 30s discounts, which is what you see today in the MIGO portfolio, and the sector have come back into favour, and the shares traded at a modest premium, you more than doubled your money. And that's the background for the explosive movements that Will was talking about at the beginning. And I think we are going to look back at the summer of 2023 as being one of those moments of opportunity where a lot of people didn't have the nerve to take the plunge. With the sort of upheaval we're seeing in the trust sector, and bear in mind we're a special situations fund investing in the closed-ended world, these conditions are absolutely ideal for us. And I think the funny thing is, if MIGO didn't exist, I think somebody would invent it. I think brilliant time to be back buying into some of these unloved and overlooked trusts at extreme discounts to the fundamental value of their portfolio. And at that point, I think we'll pass over some questions if there are any.
Thanks, Nick. I might just leave the portfolio slide up because it sometimes
might trigger the odd question.
Trigger the odd question. The first question is around cash. Despite the discount opportunities cited, cash levels remain 15 to 20%. Is that partly driven by macro concerns, or that already poor liquidity in the sector is vulnerable?
Bit of everything. I mean, we got out to 22% at one point, and what happened there was that there was two of our core holdings tendered, and we got big payments coming out of Alpha Real and Dunedin Enterprise, which whacked us up to they were both two of the very biggest holdings in the portfolio. So that took us up to 22. We're now at 12. So the direction of travel is we've been steadily spending. But I think the final point is the liquidity is tough. So in some of these situations, and the three I was talking about, we've probably got half the number of shares we're looking for, and you have to buy every day, and therefore it's not unusual for us to to take 40 or 50 trades to actually over a month or two to build that position. So there is an element of liquidity being tough, and the liquidity is probably as tough as I've seen it, which is one of the factors that creates these very big discounts, because if you get selling into these conditions, prices just keep falling.
Thank you. Why have you held New Star pretty much since launch?
Well, yes, I mean it is a play on John Duffield's inheritance practicing and or planning as an element. We've actually been selling it down a little bit recently, simply because this was a trust that has issues. It's in a competently run portfolio, but always trades at a 30-odd discount, and it still trades at a 30-odd discount. But the reason for selling it down is just the opportunity cost. We've got a lot of stuff now trading on 30-odd discounts. We don't have the same issues. So the position was about 3.5%. I think it's about 2.7 at the moment. It might end up at about 2.5. Nothing wrong with the investment. It's absolutely fine. It is just the opportunity cost when you've got a world where everything's on a 30 discount. New Star Investment Trust doesn't look particularly cheap on a 30 discount itself.
Thank you. Why do you feel that there are so many companies choosing to list outside of the UK? What impact does this have on the portfolio?
Not directly in the investment trust world, but there will be one or two that have decided that it might make, Aquila, which is one that we've actually bought into. I mean, there's every chance that might list in Europe because the assets are in Europe, and European investors will better understand it, because there is a sort of lack of demand. There's been a certain amount of de-equitization in the UK, and if an asset is better understood elsewhere, then it makes sense to list there.
How much involvement do you have with the trusts, especially those on big discounts, to look at mechanisms to close the gaps?
We're not ARBs. There's normally 2 or 3 corporate actions or things where we're actually working, with either shareholders or with boards or whatever. It's normally when things aren't going well, and they tend to be salvage operations. So there's always some activity, but it's not central to what we do. But yes, there are certainly 2 or 3 examples at the moment where there are discussions, and and we are providing input.
From experience, what is the holding period the fund owns these large discounts to either see or realize the narrowing, or decide to sell out if no movement?
We probably look ideally sort of things where the catalyst is maybe a couple of years out, because investors don't tend to look beyond 18 months, and therefore, because fund managers are judged, almost by the minute, anything over 18 months might as well be never. But we, as Will said in the introduction, our shareholders understand there's a bit of watching paint dry that's required, and therefore we can buy into things where the catalyst might be 2 or 3 years out, because there'll be no competition for the trade. So I think sometimes these things work quite quickly. Sometimes, as we touched on New Star, and uranium's another example that's been in the portfolio a long time. It can be 3 or 4 years or maybe more. So there's no hard and fast rule, but we'd expect going into them to prepare to sit there for at least a couple of years.
Thank you. Why do you think Victory Park and others are still trading at large discounts even after a catalyst event has taken place?
No buyers really. I mean, there's a few more sellers and buyers. I mean, if a trust has struggled, then people like to get it off the share register. Sometimes the ones you mentioned are quite difficult to understand. What's going on in the portfolio. But I think generally speaking, it is an opportunity. But some of these quite specialist alternatives, they've never really generated a following. And if you haven't generated a following, there will be some selling and no buying. And even though the numbers are very small, that leads to quite wide discounts.
Do you have a positive view towards the infrastructure trusts, wind, solar, biomass, now that they're on 14-ish discount levels?
We're doing some work on it, but yeah, I mean, as we drill into it, I'm not finding as many things I'm keen on buying. And this is an area where we've been doing a lot of work recently. And yeah, the big problem for me is that the direction of power prices seems to be quite opaque, and that it's very difficult to follow because for example, in Sweden there are 4 different power markets. That's just one Nordic country, and therefore it's sometimes difficult to get an understanding. And you think the portfolio is doing one thing, and then something completely left side comes and undermines it. So, funny enough, entering the amount, this period with wide discounts, I thought there would be lots and lots of opportunities, but I have only found 2 that I've wanted to buy, Aquila and one other one that we're buying into at the moment. So, as I said, just to summarise, not as many buying opportunities, or not as many things that have interested me enough to buy compared to what I would have expected just a month or 2 ago.
Do you view tender offers as a good exit route? Is 25% the normal? I think that's with JP Morgan India in mind.
I think the problem is, the trust sector seems to be a sort of corporate finances experimentation ground, and we come in all these structures. And if something's too formulaic, you just get gamed, and therefore, I'm not a great fan. I'm a great fan of taking capacity out when there's oversupply, but we just do that by buying shares in the market when we see an overhang developing. So yeah, I think the risk is being too specific, and then the market just plays you.
There's a couple of questions here on MIGO, which I'll combine. Do you worry about the size of MIGO being only 76 million market cap and below the radar for bigger managers?
No, I think the important thing is to keep the discount tight, so that there is scope to grow. Once you're on a very wide discount, it's very difficult to come back from there. The capacity is probably not that big. We have an OIC as well, so the combined is probably about 126 million. I suspect you have diseconomies of scale once you get above 250, because it would just be too much to get involved in some of these less liquid situations. We've, anything of our sort of size has been off the buy lists for the traditional wealth managers for years and years and years. So the small trusts that were going to disappear have disappeared, and the ones that actually have a role and actually have a demand. And you can't replicate the MIGO portfolio, as I just said. It takes sometimes even that size 45 or 50 trades. So yeah, I'm not too worried. I think the worries were sort of 4 or 5 years ago when this trend happened, but we've been in the wilderness for a long time now. I think the dangerous area is between 500 and 1 billion.
Thank you. What's your view on Baillie Gifford trusts, such as Scottish Mortgage and Edinburgh Worldwide? Well,
yeah, I mean, they've been off my list for a long time, but one of my to-do list is a Baillie Gifford has suggested that now they're in my universe, I should come and pay them a visit. I think they have, they articulate what they do, they take a very long-term view, and there was always the risk that at some point that the market would actually be looking at something different, and that's what's happened. So I'll probably be more likely to be a buyer than a seller.
Interesting. What makes you a bull on Vietnam in a time of such political friction in Asia?
Well, I think the political friction is the reason to be bullish, and it is a big beneficiary of the trade war between the US and China. Multinationals are hardwired into China; they can't just leave. But when they're building a new new factory or whatever, like the Apple Watch factory, it's going to be somewhere like Vietnam or India. But that's just going to be steady. But yeah, it's a beneficiary of multinationals needing to diversify the manufacturing, the supply lines away from China. So that the political sort of upheaval and tension is the very reason why we're bullish on Vietnam.
Thank you. What will be the catalyst to bring discounts back to normal?
Well, a greater acceptance of risk, sort of, or greater risk appetite, removing some supply. You know, I said that we were bound to our last 182 billion. Maybe that needs to be 160. You know, particularly in a lot of the new issues and the new asset classes that came out. There needs to be capacity taken out to get supply and demand back into order. And also, as I said, just marketing to new audiences and just catching up with how the industry has evolved. So a number of things really, rather than one sort of magic trick.
Thanks, Nick. That concludes all the questions we've had. So I will pass back to our host.
Well, Nick, that's great. And thank you very much indeed for being so generous with your time there and addressing all of those questions that came in from investors this afternoon. Nick, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, I think it's just, you know, we've seen some extreme upheaval. We've seen extremely wide discounts on a lot of trusts that have got very decent fundamentals. And I think there's a couple of points. If MIGO didn't exist, I think somebody would invent it in these conditions. And also, I suspect we'll be thinking back to the summer of 23 as one of those great opportunities that a lot of people missed.
Nick, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MIGO Opportunities Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.